Good morning, everyone. I'm here to give an explanation of the 4E5N mid-year exam, paper 2, question 2. Paper 2, question 2 is the dreaded sale of non-current asset question. So if you think you need to read the question again to revise your memory, please feel free to pause and read the question first. Or if you feel that you need to think about anything that I've just explained, please feel free to pause and think about it first. Okay, so it's a video, so pause anytime. Alright, so in this question, there was some non-current assets, alright? So equipment is I think the first part I won't go through. I will start from the bottom. Alright, I will start from B. So there was some equipment on 1st of July 2018 at cost, and there was some accumulated depreciation of the equipment. So this is 1st of July 2018. Okay, so you are told that the business sold a piece of equipment on credit. This equipment was bought on 1st of May for 24,000. So you sold a piece of equipment on credit, right? And on the same day, you purchase the new piece of equipment, right? So I'm just going to highlight it in a different color. Okay, so you purchase a new piece of equipment, and this was 35,000 on credit. So you depreciate it at 5% per year using the reducing balance method. And the business has a financial year end on 30th of June. So the first thing you want to do is that since you know you sold a piece of equipment already, you want to think about when it was sold, and you need to get rid of the cost, you need to get rid of the accumulated depreciation, right? So you need to calculate the accumulated depreciation. So you can calculate the accumulated depreciation first, okay? So question C, prepare the accumulated depreciation for the year ended 2 years, 30th of June 2019 and 2020. So I am going to calculate the depreciation for the equipment that was purchased on 1st of May and sold, and it was sold on 1st of August 2019, purchased on 1st of May and sold on 1st of August 2019. So let's calculate it. The first year is on 1st of May 2018. That's when it was bought. The first financial year end is 30th of June. So that's the first year. Now, because they tell you a full year of depreciation is charged in the year of purchase and none in the year of sale, we don't need to prorate. So we just need to calculate a full year of depreciation. So the cost 24,000, not 14,500. That this one is the selling price. Okay, this is the selling price. $24,000 is the cost. So $24,000 cost times 5%. That's your first year depreciation. All right, your second year depreciation is on 1st of July, one day after 30th of June. 1st of July to 2018 to 30th of June 2019. You haven't sold it yet on 30th of June 2019, so you continue to depreciate it. You take cost minus accum depre times 5%, and you get 1140. Pause anytime you need to think about what I said, okay? The third year, now the third year is 1st of July 2019, but you actually sold it on 1st of August. All right, you sold it on 1st of August. So since you sold it on 1st of August, it tells you here that there is no depreciation in the year of sale. So when you sell your non-current asset, there is no depreciation. So sold amount, no depreciation. Therefore, the total depreciation, right? Your total depreciation of sold asset, so NCA, is equals to 1200 plus 1140, which will give you 2340. Okay, and when you sell your NCA, the double entry that you should be recording is, the double entry is accum depre here. You need to minus it away. The other account affected is sale of NCA account. So how does this get recorded in your accumulated depreciation? All right, so you need to take note, your 1st of August 2019, right, happens after the 30th of June 2019. So all these depreciation calculation for your sold NCA didn't happen in 2009, didn't happen in 30th of June 2019, happened after that. So on 30th of June 2019, actually nothing happened. It's business as usual. All right. So if it's business as usual, how do we record this? You have a balance brought down of $14,200. Oh, where did this balance brought down come from? It's from here. All right. You have your accumulated depreciation, 14,200. So that's your balance brought down, 14,200. And then in the first year, nothing happens. So you just depreciate your equipment as usual. So how do you calculate your depreciation? It is reducing balance, right? So you take cost, which is 9,400, minus away accumulated depre, which is 14,200, times 5%. All right, so there you go. It is $4,000. So accum depre increased by $4,000. You have $18,200. Now, in the second year after 30th of June, you sold the NCA. Because you sold the NCA, right, you should take just now the double entry that we wrote, right? Accum depre minus the other account affected is sale of NCA. So now you are going to record your accum depre minus 2340. So how should we record this? Sale of NCA, or rather accumulated depreciation minus 2340. The other account affected is sale of NCA. Now the year end is 30th of June, and at the year end, you will need to calculate a depreciation of whatever equipment that you have left. All right. So don't forget that you also have a new equipment that you bought. All right. So this what I done here is that I split up the old equipment and the new equipment to record it separately because my tiny little brain cannot compute very big numbers or too many complicated things. So I like to split it up. All right. So how do I calculate the depreciation expense for the old equipment? I should take my cost, all right, my original cost, minus away 24,000. Aiyo, what is this 24,000? This $24,000 is this, all right, $24,000 of equipment that I sold. All right, this is the $24,000. Okay, so I minus away whatever I sold, and then I minus away the accumulated depreciation. What is this accumulated 15,000 accumulated depreciation? This 15,000 accumulated depreciation is this one. Can you see? All right, can you see this 15,000 accumulated depreciation? This one, $15,000 accumulated depreciation. All right, from that number. Okay, and then after I times 5%. All right. Next, I add the depreciation expense of my new equipment. So your new equipment is 35,600, and then because there's no accumulated depreciation, you just times 5%. And then after that, you have your balance brought down. Okay? All right, your next question, you are asked to prepare the journal entry to record the sales proceeds. So this one require you to know what is sales proceeds are. So sales proceeds is whatever you sold your NCA for. All right, since what you sold your NCA for, where? Over here. You sold it $14,500 on credit. All right, $14,500 on credit. So your double entry should be on credit, right? other receivables because on credit. Alright, so you debit other receivables, the other account affected because other receivables is debit, right? So you credit sale of non-current assets. Okay, alright, next, they asked you to calculate what is the gain or loss on the sale of equipment. So gain or loss equals to your net book value minus your sales proceeds. So if your net book value, why net book value minus sales proceeds? Because we know net book value, right, is what your NCA is worth to you. Alright, what your NCA is worth to you. So your net book value, minus away whatever selling price you manage to get for it. So in this case, your net book value is your cost minus accrued depre minus 14,500, and it's a loss, $7,160 loss because your net book value is high. All right, your net book value is more than 20,000, but you managed to only get 14,000 for it. All right, so you have made a loss. It's worth about 20 plus thousand to you, but you only managed to get 14,500. So you made a loss in that sense. Okay. All right. So the last question: what is the effect if you omitted this sale of non-current asset? If you did not record this sale of non-current asset, what happened to your profit for the year? All right. Profit for the year will be overstated. It will be too high. Why would it have been too high? Because you never record the loss. There was a loss. See, 7,600, $7,160 loss. You didn't record the loss, so now your profit is too high. If you recorded the loss, the profit would have reduced. So now your profit is too high. Then what if you never? Then what is the effect on current assets? Current asset is understated. Why is current asset understated? Because you take a look here, actually you have to record debit other receivables, right? Debit other receivables is a current asset. You increased your current asset. And if you did not record this, then your current asset is too low. Why too low? Because you never record other receivables, which is a CA. Okay? This question is difficult. Not many students got a good grade for this. So I have given you more topical practices for sale of non-current asset. All the best.